Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another Velocity Banking review. So, what is Velocity Banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And this video is dedicated to all of the lawyers out there who are watching this, who need some debt payoff strategies. And I know we got some lawyers who are big fans of this channel. So shout outs to you. And I was going through Reddit, right? And there's a subreddit called Law School from 4 years ago. There's a post. I'm feeling pretty down and outpaced with crushing debt. Bit of a rant, but trying to figure out what to do, right? And so people are experiencing six-figure debts and they're being crushed by it. Okay, crushed by their law school debt. So I'm not laughing because of the stress. I'm laughing because maybe there's a simple strategy to help you pay off the debt, aka velocity banking. And then you might get to a point where it's like you paid off the debt so quickly, it'll be like that scene from Legally Blonde, like, what? Like it's hard, And somebody actually showed me the clip. Shouts to you for the person who showed me the clip because I've actually never watched the movie. I know it's very famous, but let's go ahead and watch this clip.
L?
Warner? I totally forgot you go here.
What are you talking about? I'm sorry, are you here to see me?
No, silly. I go here.
You go where?
Harvard. Law school.
You got into Harvard Law?
What, like it's hard?
Go babies, 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 go babies.
Yeah. So you'll probably just do the same thing, pay off your debt quickly, and you'd be like, what? Like it's hard, right? And I do that sometimes too. In fact, if you're new to this channel, I paid off my mortgage in 2 years and 9 months. So I just casually drop that around and just like, oh yeah, you didn't do that either. I when I reference that, I reference a Simpsons clip, but we'll show a new clip today. Legally Blonde. Actually, let's replay that section one more time, okay?
Oh, silly. I go here.
You go where?
Harvard. Law school.
You got into Harvard Law?
What, like it's hard?
Okay. I've actually never watched the movie, and I think there's a Legally Blonde too, if I'm not mistaken. So maybe it's on my to-do list or bucket list. There's actually a good list of bucket list movies that I have, like Street Fighter, the movie. Never watched that. I heard it's pretty terrible, but I still want to watch it. And there's also A Christmas Story. It's like Home Alone's cousin that's not as famous, you know what I mean? But let's go ahead and get started with velocity banking. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called the line of credit. And this situation may seem familiar to you, right? If you make $150,000 income, pretty good income for a lawyer, right? And you might have, let's say, $170,000 in student debt. And we're just kind of mixing all the debt in, saying, hey, it's maybe a 7.5% blended rate. Cause I remember when I went to undergrad, I think I had three different student loans, like one at like 3%, one at 4%, and one at 7% interest rates. So we're just gonna say on average, it's 7.5% interest rate, $170,000. And so when you see that $2,000 a month payment, it could be overwhelming. Okay. And as you can see here, $150,000 a year is about $8,600 after tax. And so if you live in really expensive cities like New York, San Francisco, Los Angeles, you gotta go for broke, right? You gotta make probably 200 to $300,000 a year. If you live in Georgia, that's still a pretty sweet salary. Okay, like you can live pretty well here in Georgia. Just don't live in Atlanta, and even if you live in Atlanta, it's still not that bad, right? But $150,000 salary, $4, -$4 in savings, right? And then we got some credit card debt, we got auto loan, we'll say this is like a Toyota. We got that $170,000 student loan and then a $300,000 mortgage. So even in Georgia, a $300,000 house is still pretty sweet, right? And it's not, the home price is 300,000. Remember, you put in a 20% down payment and then the rest is the mortgage. So we'll say this is an 80% loan to value, I think. And here's the thing too, a lot of people they see these low interest rates, right? And the reason I put a low interest rate in the mortgage is because there are a ton of people who bought in the early 2020s where this could apply to, and some people freak out about using an 8% line of credit to pay a 2.8% loan. I get you, but you can still use an 8% line of credit to pay it off. And so in this last line right here, we list all of our non debt expenses, right? Food, gas, insurance, things we always have to pay for. So the whole point of this strategy is to make sure that all of your debt goes to zero, okay? And then you will increase your cash flow simply by paying off the debt. And we're going to have the help of something called a line of credit to help us do this. So even though we make the same income, and the same expenses and the same debt, we're just going to control the flow of our money so that number one, we don't save any money, right? And then number two, we optimize this number called cash flow. So this is scary to a lot of people because um, even though people don't have any money saved, right? Like I think the average person couldn't even make it in a $400 emergency. But if you deliberately not try to save money, that's scary to a lot of people. It really is. So, I'll show you a snapshot of my bank account. Money comes in and then I just put into a line of credit. It just goes out, right? So the checking account is not what we call my main operating account, okay? That is my line of credit. And so what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. That's what a line of credit is, okay? And so you the most well-known line of credit is a credit card, but it's not as flexible as a personal or home equity line of credit because let's say I have a $175 bill due from a credit card. Can I just take $175 from the credit card and pay it back? Not unless you do like a cash advance, and that's kind of expensive because every time I've done a cash advance, they charge minimum $40, or at least in one of the credit cards they did. But luckily, with my home equity line of credit, and this may possibly be me once I got access to it. This is my $280,000 home equity line of credit. I could use it to pay anything. So if a $50 bill is due from my home equity line of credit. I just take out $50 from home equity line of credit and put it back. Bill satisfied. That's crazy, right? Home equity line of credit. So you can use it to pay anything, credit cards, loans, its own bill, right? And they charge me a 7.5% interest rate. So you could go to the bank's website, click a button, and then they'll just dump money into your checking account at a 7.5% interest rate, possibly. No questions asked, at least for me, no questions asked. Okay. So that's what a line of credit is. And we're going to assume we have access to a $90,000 line of credit, right? $90,000. And so what is um, actually, I just answered your question. What is a line of credit? Now you know, right? Next question is how do you get a line of credit? Okay. And this is the part that pisses most people off because I try to tell you like how to get it and y'all don't listen, right? Most of you don't listen, okay? You have to know the secret of what the bank is looking for. And banks, so here's the ultimate secret, okay? You see it right here. Banks don't lend money to people who need it. That's the ultimate secret. And so you might, some of you comment on the channel like, I don't know what I'm talking about. Oh, you make it seem like it's so easy to get a line of credit. Well, maybe for you it's hard, but I have over $594,000 in lines of credit. 594. Let me dramatically zoom in for you. Statistically, most of you are watching this on a TV, right? I don't know if you know that YouTube like published articles about how TV is like the number one device for watching videos on YouTube nowadays. It's actually not mobile. And so if this is on your big screen TV, now you see this big $594,000 credit limit that I have because, again, I know the secret of what the banks want. And banks want to lend money to people who don't need it. Okay. And if you know that secret, you'll understand how to get lines of credit. Okay. So people try to always come out, I don't know what I'm talking about. All right. And it's like, all right, well, I guess I'm a guy with $594,000 in lines of credit and I don't know what I'm talking about. Right. And here's the point of this. The point of this isn't like, hey, if you're at -$4, the bank will give you a line of credit, right? The point of this is that this is like you crashing your car and you don't have any car insurance, okay? And then you're trying to get car insurance. No car insurance company in their right mind would give you car insurance when you crashed your car and you didn't have any and you try to apply for it, right? But here, if you have a line of credit, we'll say $90,000 free and clear. And actually, let me reset all of this, okay? Let me reset all of this. $90,000 free and clear line of credit. This would like be you having an insurance policy before you start to drive, right? And it's much easier to get that insurance policy before you start to drive than it is to crash your car and then get afterwards. But so many people are like, I just want to get it when I crash the car. And then wonder like, why isn't the bank lending me money? You know what I mean? Like that's when they try to get the line of credit, and banks don't lend money to people who need it. Okay. Now let's see the power of the line of credit if you had it afterwards. Okay. So let's just go ahead and figure out, well, which debts do we move into the line of credit? And we, a quick rule of thumb, we usually start off with high interest rate credit cards, short-term debt. That's usually high interest as well, the buy now, pay laters. And the easiest way to figure it out is by using something called the cash flow index. So basically all it is the debt, okay, divided by the monthly payment, right? And it gives you this arbitrary number. And so what does this arbitrary number mean? In fact, let me probably need to update this. Let me just quickly check if I have it right. 54, 84, 243. Is that right? Okay, good. So basically, what this means, think of it as a ranking system. The lower the number, that's the ones you want to pay off first because you get more bang for your buck in terms of your cash flow. So it certainly does not make sense for me to pay off the $300,000 first to only get $1,200 of cash flow when I could only pay, 31,000 to get about 1,000, right? You got to think about the ratios. What gives you more bang for your buck, okay? And so this is what we're going to do. We're going to move some debt into the line of credit. And how much is this? 5, 30, 31, 9. And then this is going to be a sum of all of the credit, okay? Or the credit cards. And then we're just going to shift the debt, okay? We're not going to eliminate it. We're just shifting the debt. And guess what happens when we shift that $75,000 into that line of credit, okay? This goes to 0, this goes to 0, this goes to 0, this goes to 0. And so we magically, and again, if you're on your TV, I'm going to zoom up so you can see this, right? Magically, we went from -$4 of savings, freaking out as a lawyer, to $2,443.10 of cash flow. How do we do that? Right? Same income. So here's the thing, right? When you ask the average person, okay, you ask the average person, hey, this is somebody's budget. It's their real life budget. We're not even show this velocity banking side. And they got all this debt, okay? All of it. Look at all that. Look at all that debt. That $170,000 student loan, ooh, that's a little bit spicy, right? We take a look, okay? And we got -$4 left over. Do we need to make more money to pay off our debt? And pretty much every single person that you know will say yes. Every single person, right? But here, I didn't make more money. And now, because I decided I'm not going to save it, right? I'm deliberately not going to save it. Whether I'm positive savings or negative savings, I'm deliberately not going to save it. And I've increased my cash flow, right? We literally went from negative to positive, and this is the same number. This income number is exactly the same, okay? And so now we're going to do the final step, which is put our entire paycheck into that line, all right? So basically, when we get paid, right? We get paid, we ain't putting it into our savings, right? People are like freaking out, like, you don't save money? I was like, why do I need to do that? Okay, I'm not saving money. I'm dumping all of my money into that line of credit, okay? All of it. And then so it does two things. It satisfies the minimum monthly payment, okay? That's number one. And it minimizes the interest, okay? And so once we do that and take out our expenses accordingly, we take it from the line of credit once the bills are due. Normally, I just pay everything with a credit card. And then the cool thing about the credit card is a 1-month float period. So I kind of use a combination of a HELOC and a credit card. every single month it's going to go down about 2,400. Pretty sweet, right? So we were literally going from -$4 to 2,000. And let's go ahead and demonstrate this mathematically. The math is so easy, right? It's just basic functions. So to get the next month's balance, it's the previous month's balance interest minus whatever our current cash flow number is, which is 2443.1, $2,443.10. And then what we're going to do is take the average daily balance, right? We're going to take that average, multiply it by the interest rate. In this case, it would be 8%. Mine's actually 7.5. And then you divide by 12. Divide by 12. And then look at that. Look at that. If you're a law student and you're freaking out about credit card debt, or I'm sorry, a law graduate, look at that. What? Like it's hard? No. Okay. It's not hard at all. Look at that. How do we, what? Look, this is so easy. I just put my paycheck, entire paycheck in, and look at that debt go down. Whoa, that's so easy. And now, in 35 months, we paid off all that credit card debt. Whoa, that's so simple. Okay, so how much was that? 75K of credit card debt. Okay, now we got to take care of these. 25,000. So let's take care of the auto loan first. And you might say, why is that? Well, we got this iffy, spiffy loan calculator right here. And again, we use that cash flow index system. 11 grand, get $459 back in our cash flow. So let's go ahead and do that. We get the most bang for our buck. We start off with the lowest. So let's go ahead and do that. And I'm going to do this. And so now this is going to be plus 11010.9 because that's the current balance of that loan, okay? And then we get this $459 back in our cash flow, and now we're almost at 3,000. Sweet. Okay. All right. So let's go ahead and do this. Minus 2902.39. And then you see that in 39 months, it is completely paid off. So 39 months, it is 100K. Okay, sweet. So now let's go to month 39, okay? Now let's do this, okay? So this is 0, and this is a 7.5% interest rate. So if there's a significant interest rate difference and this is a relatively high number like the mortgage, you want to be careful about moving a loan into the line of credit. Now, one of the things that prevents us of moving the entire loan into the line of credit is that there's this limit right here. But here's the cool thing about like HELOCs, right? You could always get bigger limits. So I remember my first HELOC was only about 15,000, and then next year I reapplied and they gave me a $50,000 limit. Okay. Now I'm not saying you should move this whole thing into a HELOC, but I'm okay for this demonstration. I'm okay doing it. So what I would do is maybe I'll just get another HELOC. I'll say 200,000. Okay. And then we'll move this balance into the line of credit. Now, I would never do this with a 30-year mortgage, especially a low interest rate 30-year mortgage. Got to be a little bit careful, but let's go ahead and move this into the line, plus 127,952.25. And then, okay, now we get this $2,000 of cash flow back. And now our cash flow is at $4,000, okay? And let's see how long it takes to pay off that law school loan. Remember how scared we were that we're posting on Reddit because our law school loan is way too overwhelming? Remember that? That's not us anymore. That's not us, okay? 4920.32 is our cash flow. And then let's see how long it takes us to pay it off. And so... all right, so now 68 months to pay it off. So 68 minus 39, we just have to do a quick calculation, but let's do 68 months equals, so that's 270K, okay? And where did we start at? We at 127. So, I mean, we paid off about a little bit less than $50,000 of the loan after about 3 years. And then once we started to focus on that sucker and apply all of our money into debt, which is what velocity banking is, we paid it off in a little bit over 2 years. So 29 months. Okay. So let me just ask ChatGPT this. So give me one moment. Okay. Give me one moment. So let me ask ChatGPT. If I'm a lawyer making 150K a year and it only took me about 29 months to pay off my student loan, would most of my lawyer colleagues be surprised or act like it's normal? Let's see what ChatGPT says. It's no joke. That's what ChatGPT says. So let's read it out loud.
If you're a lawyer making 150 calories a year and you paid off your student loans in just 29 months, most of your colleagues would probably be impressed or at least take notice. That's definitely on the faster end of the spectrum. Here's why that would stand out a bit. Law school debt is no joke. A lot of lawyers graduate with 100K to 200K plus in student loans. Paying that off in under 2.5 years usually means serious budgeting, aggressive payments, or maybe some extra windfalls, bonuses, help from family, etc. Many lawyers make minimum payments for years, especially early in their careers. Income-based repayment plans or 10 to 25-year timelines are pretty common. Even among high earners, it's easy to fall into a lifestyle creep where they spend more as they earn more, which slows down debt repayment. So if you share that with your peers, some might ask how you did it. Others might joke that you're either super disciplined or living like a student while making six figures. A few might find it normal, especially if they're big on FIRE, financial independence, retire early, or have similar financial goals. Out of curiosity, did you do anything unusual to knock it out that fast, or was it just tight budgeting and focus?
I wonder what strategy I used. All right, so now time to focus on the last thing, which is the mortgage. And so at 68 months, this is our mortgage. And like I said, you got to be careful, right? You don't want to move this whole thing into a line of credit, even if you could. And let me just show you the difference. So there's two ways you could pay it off. Move the loan into the line of credit, which I don't recommend unless the interest rate is comparable, or, okay, or the CFI number is really low. Okay. So if it's like 2.8%, but it's a really low CFI number, I'm okay with moving that into a line of credit usually. Okay. But if this number is low and this number is high, we might want to rethink that. So give me one moment to pull out the velocity banking calculator. All right. So this is the velocity banking calculator. Provided by Renanis. So if you don't know what Renanis is, it's where I learned a lot of stuff from, and including velocity banking. So if you're interested in not only just velocity banking, but learning more stuff, which I won't talk about here, and it's possibly a gateway entry into a cult that I've made, click the Google form link below. But other than that, just a quick plug. I actually do make commission from selling their stuff. But other than that, let me go ahead and do this, which is input the information. So if I just do this, so we're at 300,000 original balance. The current balance is 260,795.12, 260,795.12. And then the interest rate, very low, 2.8%. And what's the payment? The payment is 1232.68. 1232.68. All right. So now what is the monthly income? The monthly income is, let's go back here, 8653. So 8653. And then the living expenses is everything except for the loan we're trying to pay off. So it's this 2,500 right here. So I got to put in the 2,500. Now, let me just demonstrate this to you first, because some of you might have heard this on the internets where people are saying, hey, you should move, even if you have a 2.8% mortgage, loans are all bad. So it's okay if you move it into a line of credit. And let me just do this right here. So you can see right here, oh, you might be really impressed because it's 4.2 years and you're only paying 47,000. But let me just show you this. Let's just put it in a small chunk, $9,000 chunks, and repay that chunk over and over again. Oh my goodness, you're only paying 15 grand of interest in 3.8 years. Now, here's the other crazy thing, right? If I use a 30% credit card, okay, 30% credit card, that beats out the 8%, what we call a first lien home equity line of credit, meaning you move this entire thing into a loan. A lot of people don't understand this, right? It's very unintuitive, but even a 30% credit card will beat that 8% first lien home equity line of credit. So let's move this to 8%, 15 grand, 3.8 years, pretty sweet. So let's go ahead and do this. And then this is 0, and then 68 plus 3.8 year, well, no, hold on, 68 divided by 12 equals 3.8 years. So it's 9.47 years, and we are debt free. And then now, okay, we take a look at this. Ooh, we got $6,100 left over in the bank every single month, and it took us less than 10 years to do it. Okay, less than 10 years. You ever hear those like velocity banking videos where it's like pay off your mortgage in 7 to 10 years? We actually did it in 3.8. Okay, 3.8. So 9.47 years to be completely debt free. Okay, 9.47 years, but we paid off our mortgage in about 3.8. And you know, as I said before, I paid mine off in 2 years and 9 months, right? In 2 years and 9 months. And once you pay off your debt, I mean, you know, ChatGPT says most of your colleagues will be pretty shocked if you pay off your just your law school debt in under 3 years. I paid off my mortgage in under 3, and then you'll just be like, "What? Pay off debt quickly? Like it's hard?" Right? Actually, let's just play this one more time. Let's just play this one more time. Let me go ahead and see that one more. Let's see this. I should watch the movie after this. Now I'm inspired. Right now I'm inspired. Maybe I could go to Harvard too. Actually, I'm not that smart, but
Oh, silly. I go here.
You go where?
Harvard. Law school.
You got into Harvard Law?
What, like it's hard?
okay. So if you made it all the way to this video, you know, I always like to say, write a comment, write this comment below. And I guess the comment for the day, you know, if you made it to the end of this video, so I can know you made it to the end, is pay off debt quickly. What? Like it's hard? That's actually the title of the video, but that's how I know you watched to the end. All right. Well, that's it for today, folks. This is Korean Atlanta Mentorship. Have a great day, and share this with a struggling, actually, I don't know if they're actually struggling, but a lawyer from Harvard. Maybe they might be impressed. I don't know. All right. So have a great day, everybody, and I'll see you all in the next video. It's Korean Atlanta Mentorship.